nice introduction. I just want to let everybody know that I am a new CASPA member as well. I joined about 2 years ago because the president then asked me that you can join. I'm actually a software professional, and I thought that, this is for semiconductor. It's actually not. It's open to all. So I would highly encourage everyone, if you are interested in learning about technology and also networking with capable people, please feel free to do so. Now, back to our main topic. Dr. David Rowe earned a bachelor's degree in economics from Carleton College and an MBA from Wharton Business School, and also PhD in econometrics from University of Pennsylvania. He worked at Wharton Econometrics Forecasting as a economics analyst early of his career. And then what's amazing is that he worked in the Congressional Budget Office, which is so important at the federal level early of his career as well. After that, he worked as a director of research for Thomson, the Greenspan and Corporation. I'm sure everybody knows Alan Greenspan. So that's the early part of his career. And of course, he was a professor as well. That is why he is so elegantly at everything, at teaching specifically. So we're so honored to have opportunity to learn from him. After that, he switched to work on the risk management part, worked as a vice president at Security Pacific Bank. With the acquisition, joined the Bank of America. That's where I was very fortunate to be his software engineer. So 28 years ago, I was his assistant, and Dave and I worked together, and we developed the first risk management software for Bank of America. And we are still business partners now. After Bank of America he joined SunGard and also Mises, and continued on as his own firm, David M Rowe Risk Advisory. So with such a successful career, he has also so many achievements that just to name a few here. Of course, we talk about that he originated and implemented the Bank of America's first simulation-based derivative credit exposure system back in 1993. When we were young, we're still young. And he also authored the monthly risk analysis column in Risk Magazine from 1999 to 2015. That is the most prestigious magazine in risk management in the world. Of course, his recent book of An Insider's Guide to Risk Management is so profoundly rich in content, and I'm honored to have had the opportunity to translate his book from English to Chinese, where I believe that it's going to benefit the economy in China a great deal. One of his highlights is also the Professional Risk Managers International Association Risk Manager of the Year in 2013. With so many achievements, Dave is very warm-hearted and always willing to help all of us. I think that's just being part of his being a professor and being such a loving person with a loving heart and his knowledge. I am very fortunate since my first job after graduate school that I had the fortune to learn from him directly, and his wisdom, his guidance guided my career, and I'm very honored to have this opportunity to introduce Dr. David Rowe. So with that, let's all learn from him, and please feel free to ask any questions by typing in the chat room so that I can review, and then we will have the Q&A session at the end. So the format of today's talk is very simple. We'll learn from Dave directly. And then after that, we can have a few minutes. If you have any urgent questions, we can ask it directly related to option trading, because our main topic today is option trading. Even though risk management is huge, is everywhere, but to get us started, we'll focus on the option pricing. So if you have any question regarding option pricing, so feel free to ask. And then we'll have opportunity to have a chat so that Dave can share more about risk management in general, and also can talk about his book. And then we'll after that, we'll have a Q&A as well. So we'll end at 6 p.m. So feel free to ask questions. So whoever asks first, you'll have opportunity to learn from him about his answer. So welcome. Dave?
So let me share my screen. I think we're here. Let me make sure that this is working now. 1 second here. I had a problem before. Let's see, 1 second. There we go. Okay. So can everybody see my screen? Yulin, are you seeing it?
Mm-hmm.
Okay. The topic today, and I hope nobody is here sort of under mistaken pretenses. That is, this is a presentation, a variation and an expansion of a presentation I actually did back in my Bank of America days. And the purpose of it fundamentally was to try to explain to credit officers who were responsible for approving trading limits and the credit implications of trading limits for various counterparties. The difficulty we had is that those people were very well trained in financial spreadsheet analysis. They knew their industries, they knew their companies over which they had control in terms of the credit availability, but really they didn't understand a lot of the trading aspects that the bank began to move into. All banks began to move into very strongly in the late 80s and 1990s. So this was an attempt to try to explain to non-mathematical people, what is this whole idea of how do you value the price of an option, and how does it behave, and what's it all about? And most presentations that say they're valuation presentations very quickly get into mathematics, and very heavy mathematics. And most people that are not really adept and trained in mathematics walk away thinking, I don't know much more than when I came in, right? They memorize a few formulas, but it still doesn't make sense. So the point of this exercise was to try to convey the fundamental concept behind option pricing without recourse to any mathematics at all. So let me begin with a fundamental insight that is important in terms of thinking about this problem of determining a fair value of an option. I can't really, at this point, I have to ask people to accept this on faith. I can't really justify this effectively, but the fact is, given a stable random distribution of changes in an asset price, now that's a very important condition. And one question we may want to talk about afterwards is, to what extent does the real world correspond to this assumption, okay? But we're starting from the assumption that prices are distributed randomly and it's a stable random distribution. And if we start from that assumption, then the payoff of an option on an asset can be duplicated with nearly perfect accuracy by a continuously adjusted combination of non-option type instruments. This is the key insight. One of the implications of that is that you can hedge the risk in an option position by using non-option instruments. And the upshot of that is there's no real reason why there is some extra risk involved in option trading that has to be compensated. There may be some costs in terms of the adjustment of the underlying hedges, but fundamentally what it says is that the price of an option under these circumstances must equal the present value of all the possible payoffs at expiry of the option, weighted by the probability of each one occurring. Any other price is going to result in opportunities for virtually risk-free arbitrage gains. So basically what we're trying to do when we value an option is assess what are the various possible outcomes and what will be essentially the expected present value of all of those future outcomes. So I'd like to sort of motivate this by a story, which is, let's say a friend of yours owes you a favor and they come in one morning and they give you a contract that lets you buy a certain number of shares of a given stock a week from today. Now, you'd be surprised, and it's hard here because when I do this live, I usually get into some real interaction. I'll ask people, well, what is it? If this contract allows you to buy it at $100 a share, and the price today is $100 a share, well, what's the value of that contract? And some people look at that and say, well, why is it worth anything? I can buy it today for $100 a share. Well, the point is, you're not buying it today. You're buying it in a week's time. And so I say, well, it is worth something. Is it worth more than zero? And if anybody claims it's zero, then you say, well, if this was really worthless, you would just throw it away, right? You'd put it through the shredder. But probably you would stick it in your briefcase and wait a week to find out what was going to happen, right? So it can't be worth zero, because otherwise you wouldn't go to the trouble of carrying it around for a week. The issue gets a little more complicated if you receive this at 8 o'clock and at 9 o'clock, the friend in the next office comes in and you say, oh, look at this present that I got. This is a contract. It lets me buy, so many shares of such and such a stock for $100 in a week's time. And it was written by, Citibank or Goldman Sachs, or somebody is going to honor the contract. And your friend from next door says, well, wait a minute, that's kind of neat. I'd kind of like it. What would you want? What would I have to pay you to buy that from you? Well, now the problem gets a little more complicated. It's not worth zero. It's clearly got to be worth something positive, but what's that number? That's really the issue. Well, to do that, we need to begin to think about what is the range of possible prices that the stock might exhibit in a week's time. So let's say we look at the last several weeks, we look at the last 6 months, we look at the last 1 or 2 years. We come up basically with a reasonable sense that the range of values for the price in a week is going to be a normal distribution around the current price of essentially $100. And in this case, I've drawn a normal distribution with a standard deviation over the course of a week of $1 or 1% of the price. So we're looking at a normal distribution. 4 standard deviations would take us from 96 at the low to 104 at the high. That's sort of, let's say, a market's broad consensus view of how volatile we think the price of the stock is. So where do we start? Well, it turns out, just looking at this, I'm going to make one simplifying assumption. I'm going to assume that the stock trades in increments of 10 cents, just to kind of simplify the analysis. So in that case, there's a 4% chance that the price is unchanged. It's going to be 100 as it is today, a week from now. There's about a 2.5% chance it'll go up to 101. There's about less than 0.5% chance it'll go to 102, and less than a 0.2% chance it'll go to 102.5. If you took at all of these values, obviously from 96 to 104, you're going to get something close to a total probability of 1 of all the possibilities. So where does that take us? Well, we have to start to look at what would be the payoffs for this option that we hold under these different circumstances. Remember, the strike price is 100, which means I can buy it for 100. I will be able then to turn around and sell it at the price that prevails in a week's time. So what's the payoff under these different circumstances? Well, first of all, For anything out to a price of 100, the payoff is going to be 0, right? Because if it's still at 100 in a week's time, or if it's anything less, we're certainly not going to exercise the option and buy it for more than I could buy it for in the market. So that much is clear. Okay, if in fact the price goes to $100.10 from that previous graph, the likelihood of that is just slightly less than 4%. So we take 4% times the payoff, which will be 10 cents, right? The difference between the price in a week that we're assuming and the $100. And that contributes a little less than half a cent, 0.4 cents, to the value of the option. If in fact the price went to 101, then the probability of that is 2.4% from that normal curve that I first drew, and the payoff is now $1. So the contribution of that possible event is 2.4% times $1 is 2.4 cents. If I say, what's the possibility if it goes to 102? That's about a 0.5% probability. The contribution is a little over a penny. If I'm going to go to $102.50, we're down to a 0.4% probability, but the payoff's pretty big. Payoff's $2.50. So I multiply the two together, I get a contribution of a little less than half a cent. If I take all of those possibilities for all of those range of values that I've looked at from 100 out to, actually from 96 out to 104, I'll get a chart that looks like this. And if I go and I add up all of these individual contributions, calculated similarly to the ones I show in red, what you'll discover is that the sum of all of these non-trivial possibilities, obviously it could go higher than 104, but it seems highly unlikely, at least in terms of the current sense of price volatility. We add these all up and we get 40 cents a share. But that's the price. So if it's, it's that times if it's for 100 shares, then we multiply everything by 100. But let's just look at a single share. So if it's an option on a single share, it should be worth about 40 cents. So how might that change if in fact we change the terms? What if the strike price is not 100, but it's 101? So you're now $1 away at 100. It's got to go up $1 before you even start to get to 0, right? So now the payoff is going to be 0 all the way out to a price of 101. It's only when we get a little higher, let's say at $101.50, I'll get a 50-cent payoff. The probability, that's 1.3%. That's going to give me about 0.65 cents as a contribution. The possibility that the price might go to 102, which we saw before, is about 0.54%. Now the payoff is not $2, it's only $1, so the contribution basically is about 0.54 cents. Similarly, the probability of 102.5 is 0.18%. The payoff's $1.50. That's contributing 0.26 cents. And if I look at all of these, you can just tell from the area, obviously, we're going to get a smaller number. If we just add up all of these bars, in fact, we're going to get 8 cents a share, a very substantial reduction from the 40 cents a share we got when the strike price was at $100 a share. Let's do one more of these. If I increase the strike price to 102, needless to say, I think we all know what's going to happen. The payoff is 0 all the way out to the price of 102. Only when we get to something like 102.50 do we get any payoff at all. In this case, we get 50 cents payoff, but the probability is only less than 0.2%. So this literally contributes about 0.1 cent, right, to the value of this option. And the total value looks like that. And in fact, the total share is less. Total value of an option struck at 102 when the price is currently 100 and the volatility is what we've argued it should be, is literally going to be less than a penny. So the value when you're out of the money declines very quickly. Let's do one more. Let's move the strike price the other way. What if the contract we were given let us buy the shares at 99? It's already at 100. Well, this is a different story. In fact, I'm going to have to change the graph, because you'll notice on the left, the scale is from 0 to 3 cents for each of these possible contributions. I now have to double the size of that graph. So it's now going to go 0 to 6 cents for each possible outcome. because nothing, the payoff will be zero all the way out to a price of 99. That is to say, the price could fall by $1 before it gets down to that. So it could fall, but if it falls less than $1, there'll still be a payoff. So if the price turns out to be 99.50, i.e. it's fallen by 50 cents from the current market, the probability of that is 3.2%, but the payoff is still 50 cents. So that's going to contribute a little less than 2 cents to the price of this option. If the price is unchanged and in a week, it's still $100 a share. Well, the payoff in this case is going to be $1. We already know that's 4%. That's going to contribute 4 cents to the value of the option. The possibility of a price of $100.50, probability of 3.5, multiply that out, the payoff is $1.50, that contributes about a little over 5 cents. The probability of a price of 101.5 is 1.3%, but now we're talking a $2.50 payoff. So when you take the probability, we end up basically contributing about 3 cents for that possible outcome. We go to 102.50, we have a $3.50 payoff, 0.18% likelihood, and a little less than half a cent. And now if we put these all out, you've got a chart that looks like this. Now visually this is a lot more, but it's deceiving. It's even a lot more than it appears here because of course I've changed the scale. So in fact, if I take what that payoff valuation chart looked like when it was $100 a share and I plot it on this scale, basically I'm going to get something that looks like this. This is what that original chart that I did before would look like if I plotted it on this scale going from 0 to 6 cents. So you can pretty well see the area under the green line is certainly less than half the total area of everything under the top line. And in fact, if we went back and we added up all of these things for the option struck at 99, we will discover that the value of that option is $1.08. Obviously a substantial increase from the 40 cents that was the value of the option struck at 100, as opposed to something that's already $1 into the money. Okay. If we, let me look, sorry, here, shift this around here. I got something on my screen. Okay, so we want to look at basically how does the value change versus the sort of the in the money position, right? We saw when we had an option that was struck at 100, which meant the in the money position was 0. The value was 40 cents. We saw that, sorry, I lost mine. There we go. If the option is $1 in the money, that is the strike price is 99, we saw that the value of the option is $1.08. If it's $2 in the money, so the strike was 98, the value is going to be $2.01. If we look basically the other way, if it's essentially 50 cents out of the money, that is the strike price is $100.50, then the option value, we didn't do this calculation, but if we did the same thing, it'll come out to be 19 cents. If we go to something which is essentially $1.50 out of the money, the value of the option falls to 3 cents. And if I plot all of these option values based in the money position, we get a curve that looks like this. Now, one of the things that you realize is this is not linear. There's quite a bit of curvature here, at least particularly around the part right here in the middle. So essentially, one of the things that we want to look at is how this relates to what we call intrinsic value. So the black line that you see here is the so-called intrinsic value of the option. The best way to think of that is to say it's what the option would be worth if you had to exercise it today. Well, that's pretty clear. It's just the difference between the current market price and the strike price of the option. So everything out to 100, that is, it's at the money, is going to be worth 0 if you have to exercise it today. As you start to move further into the money, you get a 1-for-1 increase. So this is just essentially a 45-degree line. Any increase in the money position is an increase in the value of the contract. Anything to the left of the strike price is going to be 0. So that's basically the intrinsic value. And that raises the question, how do we think about this area that is above the black line, right? This is what is called, interestingly enough, time value. Essentially, it's the difference between the value of the option in reality, given it's a week to expiry, versus the intrinsic value of the option is what it would be worth if, in fact, you had to exercise it today. That's the basis for the so-called time value. There's a value in the option greater than the intrinsic value because it doesn't exercise today. There is room for the price of the underlying to move relative to the strike price over the remaining time that the option is going to be in effect. If I look at this time value alone, I'm going to get a chart that looks like this. And it's interesting because the time value is maximum right when the option is at the money. So it's right in the middle. And the best way to think about that, I think, is that in that case, half the results are negative, i.e. you get zero, but the whole other half of the distribution as to where prices might be gives you some gain. So there's a significant gain. It's pretty clear why that time value drops off if you go way out of the money, because you're not going to very likely get back to the point where you get any payoff. The farther you go out of the money, the less likely it is there's ever going to be something that's going to give you a payoff. What's a little more puzzling when you first start to think about this is, why does this drop off as you go farther in the money? And I think the best way to think about that is, if you have an option which is $2 in the money, that is, it lets you buy it, let's say at 98, and the current price is 100, but it doesn't let you buy it at 98 today. It lets you buy it at 98 a week from now. And in that case, you're already in the money, and the movement in prices can very well go against you substantially. It can erode a significant amount of your intrinsic value. So essentially, the interesting thing is that the time value drops off in both directions relative to its value when you are an at the money option. So this option is worth 40 cents. This one is worth 19 cents. This one is worth 3 cents. This is $1.08. This is $1.01. But the point being, the time value, that is the difference between the in the money position, the time value is down to 8 and down to 1 as you move farther and farther into the money. Basically, another thing that is frequently talked about with options is what's the relationship between a change in the price of the underlying asset and the change in the price of the option. So if we take some examples using exactly what I've done, if the in the money, if you're $1.80 in the money, the option is going to be worth 1.814. If you're $2 in the money, it's going to be 2.08. So that, in fact, the difference here, the in the money position has changed by 20 cents, but the price of the option has changed by 19.4 cents. So the ratio is almost 1. It's not quite 1. That is to say, this is not linear out here perfectly, but you're getting pretty close to 1. If you look at what happens around the at the money position, if the at the money position was in the money 10 cents, the option will be worth 45.1 cents. If I move it 10 cents out of the money, the price is going to drop to 35.1 cents. So essentially, the difference in the 20-cent difference in the price of the asset is creating a 10-cent difference in the price of the option. And if I come out to the bottom here, I find that I go from $1.40 out of the money to $1.60 out of the money. The price goes from 3.7 to 2.3. So in fact, we get a 1.4 cent change relative to a 20-cent change in the asset, and that ratio has dropped down to like 0.07. What's happening here is that essentially right around the in the money position, we see that it's the so-called delta, which is the relationship between the change in the value of the option and the change in the value of the asset, is about 0.5. This illustrates, by the way, what I said before, is that you can hedge the risk, the directional risk of your position so that if someone, if a trader or a trading desk has written an option to you for this contract at $100 a share, that first one we looked at, a call that will sell you for $100 a share. If the market moves a little bit, they're going to lose money if the price goes up. How can they hedge that? Well, the way they can hedge it is they can buy a volume of shares equal to half the amount quoted in the option, because the amount quoted it will move by half the change in value of the amount quoted in the option. So if I have half the number of shares, the movement on that will be 1 for 1, and you'll have exactly the same offset to the change in the value of your option position. So this is the way that traders can hedge the directional risk that they take on when in fact they write an option. So the so-called delta is essentially, typically in virtually every option situation, 0.5 when you're at the money. It's approaching 1 as you get well into the money, and it tends to approach 0 as you move farther and farther out of the money. Now, a lot of times when you hear people say somebody's playing with options, people get scared. They say, "Oh my gosh, he's going to bankrupt himself." It's important to recognize options can be used to reduce your risk as well as increase your risk. And just to make that point as simply as possible, let's take 2 examples. Let's say I have $100 and I go out and I buy 1 share of this underlying stock. Well, this red line is going to be where the value will be, in a week. If the stock is 97, then my position is going to be 97. If it's 102, it's going to be 102, right? It's just 1 for 1. Ask yourself the second question, though. What if instead of buying the 1 share for $100, I put $99.6 in the bank and just let it sit in cash, and I take the other 40 cents and I buy an option that lets me acquire the shares for $100 in a week's time? What would the payoff of that position be a week later? Well, basically, if it's still $100 a share, it's going to be essentially, worthless. You're going to be left with the value of you're going to be left with the value you had in the bank. So if I look at where we would be, let's say in a week's time it's at 102. If I bought the shares, the value of my position would be 102. If I've done the second thing, the value here is going to be 101.6, because I'm basically going to make $2 on the option, and I'm still going to have the $99.60 in the bank. My total position is going to be $101.60. If the price has gone to 97, my option is going to be worthless, but I'm still going to have the $99.06 rather than just $97. So if I've taken this position, the risky one is the non-option position in red. The option position in blue is less risky because I've cushioned myself against a huge loss if the market collapses, and I've given up a little bit, obviously, if the market goes in the money, because I have to pay for the options, but it's kind of the cost of insurance to protect me against the big decline. Now, the other side of that story is how you get killed or how you get rich using options. Again, let's take a comparison. Notice the vertical axis here has changed dramatically. Now we're going from 0 to 600, okay? If I look at the value of 1 share, well, this looks like a horizontal line, but it's not. It's the same line we had before, because this is basically 97 at this end at the left and 102 at the right. It's just that the scale has expanded so much it almost looks like a vertical line or a horizontal line, but it's not. So let's say that's my one alternative. I buy the share and that's my payoff. But now consider the following alternative. Instead of that, I've got $100. These options are 40 cents each per share. I can buy an option on 250 shares that I can buy 250 shares at $1 a share in a week's time. The question is, how will that look depending on whether the price goes, where it falls between 97 and 102 at the end of the week? Well, basically, if that price goes to 102, I've made $2 on each on 250 shares, and my value of my position is going to be $500. On the other hand, if the price goes down to as little as 98, I virtually lost the entire $100. It's gone, right? This is the kind of way of playing the market that can get you killed if you basically, decide to go that route. Okay, now we get to really what is the heart of option trading. Let's say, for argument's sake, that the company, maybe there's been a stock split, and that the company is Tesla, and it's trading at $100 a share, and same story, you got this contract to buy it at $100 a share at 8 o'clock. At 10 o'clock, let's assume the chief financial officer of Tesla goes on the TV, and he has two rather startling announcemements. One is that Tesla has just recorded an unexpectedly record high performance. Earnings were high, sales were high. It's an all-out blowout in terms of, performance. And Elon Musk is checked into a hospital to be ruled out as to whether he may have had a heart attack. Well, in the price, let's just say, because of these two dramatically contrasting announcements, continues to stand at $100 a share. The question is, how would that affect the value of this option you've been given that lets you buy the shares at $100 in a week's time? Well, I love to do this in a live audience because you'll get all kinds of answers, But the simple answer is, if you stop to think about it, is how has that changed this distribution that you're looking at on the screen? And I think the obvious and intuitive answer is it's going to make it more spread out, right? One of two things is likely to happen. Either this was, sort of indigestion or something, and Elon Musk is just fine, thank you very much, and that whole concern goes away, and all of the blowout earnings become the story. Or alternative, maybe Elon Musk dies, and now you're not clear. There's, turnover in the top management. There's confusion. There's uncertainty, and the price goes way down. Essentially, let's say the market looks at all of this and they say, okay, there's greater uncertainty around where that will be, and let's say that distribution looks something like this. The way I've drawn this is basically a normal distribution centered on $100 a share with a volatility of $1.50 instead of $1, or 1.5% of the value of the shares. Is kind of the range that we expect to occur in a week's time. Let's just say this is market consensus. So the question is, how would this new distribution of possible prices in a week affect the value of their contract? Well, we know how to do that, right? We can go back and we can look at all the range of possibilities, look at the payoffs, look at the probabilities, and add them up. But there's one thing that we know for sure. Everything to the left of 100 means, in either case, before and after, the option is going to be worthless. It goes to zero. It doesn't matter if the price goes to 99 or 90 or 80. It's anything below 100 is zero. So really nothing on that side of the distribution will have changed. The impact is exactly the same. However, looking to the right, the probabilities of these payoffs cross at $1.20. At a possible future price below $1.20, these probabilities that were there before have now disappeared, and they've been reallocated over here into prices $102.10 and greater. So what's happened is we've reallocated some probability from small payoffs, comparatively speaking, over into comparatively large payoffs as we move to the right. If we go through the exercise we've done before, This is with a volatility of 1%, strike price of 100. This is the same chart we had at the very beginning. We add these all up, we get 40 cents a share. If we do that same exercise based on a volatility of $1.50 or 1.5%, we end up getting a curve that looks like this. And what you can see is that the values that you have to add up, everything to the left of $1.20, essentially these payoffs have disappeared, right? Those percentages are lower of those payoffs, but the fact is they've been redistributed over to where you get payoffs out in here. They're significantly larger. And it doesn't take much visually to say that the area in blue is a lot bigger than the area in red. If I go through and sure enough, I add up all these contributions for this option that basically is now at a 1.5% volatility, we find that the option value has gone from 40 cents to 59 cents. So that's basically what's going on here. A change in volatility has had a significant impact on the price of the option, even though there was no immediate change in the price of the underlying asset. Now, I say, who are these guys, Black-Scholes, and why are they making my life so complicated? A lot of the option pricing concepts got kicked off back in 1973. This is the Journal of Political Economy, May, June, 1973. The interesting thing is, this article is number 6 on the masthead. This is one of the most frequently cited articles in finance in the last 30 years. And it was number 6 in the table of contents in this issue of the Journal of Political Economy, which means they had not a clue what they had on their hands, basically. But it's basically the pricing of options and corporate liabilities by Fisher Black and Meyer and Shoals. They created an equation, and that equation, and this is it. This is usually something you get on slide 2 of most of these presentations. And the problem is that if you're trying to make this explanation to somebody who's not mathematically inclined, this is going to be total gobbledygook. But quite honestly, if you're a general business person, you don't need to understand this. I do think you need to understand what I've just gone through, is that what you're trying to do is to evaluate the expected present value of all of the potential future outcomes. That's what you're doing. Now, what's interesting in this formula, let's look at what's in it. Prevailing asset price, which was in our examples, 100 or 101 or 102 or 99. I'm sorry, with a various, the prevailing asset price is $100 a share. I said that wrong. That's the P. The strike price of the call option is we've looked at alternatives of 100, 101, 102, and 99. The asset price volatility, we've looked at a 1% volatility over a week and a 1.5% volatility over a week. The time remaining to expiry of the call, that's in there because we normally quote volatility for, let's say, a day, and that volatility has to be turned into an irrelevant volatility for whatever is the remaining life of the option. So we kind of finesse that by always talking about a week. The riskless rate of interest is in there because essentially you do need to discount all these payoffs back for the period of the option. Again, I finesse that because it's really not all that big a deal if you're only talking a week. If you're talking 6 months or a year, obviously that becomes a much bigger kind of thing. N is the value of the cumulative standard distribution at the point X, from minus infinity up to X. That's the N over here, that's this function. And C, the answer, is the arbitrage-free price of the call option. That's what the formula expresses to do. All you really need to know is look at the examples that we've just done. We looked at 4 different strike prices, actually 5 different strike prices. We looked at 4 strike prices at 1% and one same strike price at 1.5%. We got the answers that I show here. These are, with a few more digits, are the answers, the values of the option based on the analysis, that sort of brute force, look at all the outcomes, look at the probabilities, multiply them out, add them up, you get these answers. On the right is the answer you would get if I had used the Black-Scholes formula on exactly this same problem. And you can see they're virtually, the same. Why are they different? I'm assuming 10 cents, increments. Black-Scholes assumes essentially continuous pricing. I stopped at 4 standard deviations. It's, there is some probability in the normal distribution beyond that. So yeah, you're going to get a little bit of difference. But the essential point is that this Black-Scholes formula is for this kind of option, for a so-called European option, which has to be settled on a specific date based on the price on that date. You have this handy shortcut. It's important to, and all it's doing is essentially in a shorthand way coming up with the same answer we got by brute force. One of the things to keep in mind is if I change the nature of the option, for example, some options are called Asian options, and they are based upon the average price every day between now or between inception and the expiry of the option. Well, then you can't just look at the distribution of the price on the last day. You have to look at all the possible paths that price could take over the course of the life of the option. Much more complicated problem. And in a sense, any kind of valuation scheme that people use is a way of simplifying something very similar to what I did for this European option. Look at all the different outcomes, look at their probabilities, and in fact, go through the process of adding them up. So, Black-Scholes formula provides a computationally efficient way to derive arbitrage-free option prices for European options only, I should say, given observed characteristics of the option and the current price of the underlying asset, and a market consensus on the instability, that is the volatility of the underlying price. But you don't need to understand why that sort of magical mathematical trick actually works. You need to know that what it's doing is exactly the same sort of brute force procedure that I described. One final thing to point out, and that is option traders trade volatility. They do not, or at least do not primarily, trade directional changes in the price of the asset. Not saying they don't do that occasionally, but generally speaking, they are shifting a holding in the underlying asset to pretty much neutral in terms of changes in the price. The kind of things that option traders are really concerned about is primarily that last example, where there may be something that creates significant new volatility, and we saw that will in fact increase the value of the option, or they may have the reverse and they may think, okay, things are going to be stable, I can just collect my premium and I'm going to be okay. But it is essentially changes in the consensus view of volatility, which is the sort of uncertain variable that option traders are trading. So with that, that concludes my presentation, and I think we will go back to looking at some questions and answers. Yulin, I think you're on. I'm not sure, but I'm not hearing you.
Hello?
I think you're on. There you are. Yeah, I think you're on mute. Okay.
Well, wow. I feel that I'm back to my days working with.
That's right.
So every day I learn a great deal when I work with Dave on developing the risk management software. So now you can all experience what I experienced when I was working with him, except that ours is, I need to translate his formulas to software. And then we work really bit by bit. Every number needs to be correct because otherwise it's going to be used by traders worldwide. So anyway, there are very intelligent questions here. Let's get, because they are relevant to this talk. So let's have them answered before we move to the fireside chat session. The first is this presentation can be applied to cyber currencies, can this, or something is different?
Yes, it could be applied. You could write options on Bitcoin. Bitcoin has a lot of volatility, right? So, in fact, there's definitely a significant potential. It would take a certain number of traders wanting to engage in this. They would have to be able to. What I don't know is what is the cost of readjusting the Bitcoin hedge you would need to protect yourself against directional change. That could be a problem because you often have to readjust your position. And I don't know to what extent there is some cost of transactions with cyber currencies that would tend to eat up, a lot of cost in terms of maintaining a trader's hedge. But in principle, there's no reason it shouldn't be applied.
Okay. How about if the distribution is not normal? Would the conclusion still stand?
Well, that's a very good question. You can make a pretty good case, for example, that it maybe shouldn't be normal, it maybe should be log normal. You basically got to be centered on the current market price, because the argument is if this distribution was not centered on the current market price, then the market price would change. That would be saying that traders' expectation is that the expected change is not zero. The expected change is it's going to move up in a week. Well, then everybody would be trying to buy, and the price would move up immediately. So yes, there is a question. One of the big questions that arises is that it is not normal. If you look at price changes and you distribute them, you tend to get what statisticians call a leptokurtotic distribution, which basically just means it has fatter tails. It's lower in the center and it has more weight out in the extreme tails. Largely that's because the real world violates that very first assumption I put up there of a stable random distribution. Right? What we have is essentially an unstable random distribution. And it is those kinds of sudden changes that will give events that occur larger, big events in the tails than you would typically expect based on a normal distribution. And so there's various ways that traders have tweaked the formulas in terms of adjusting for out of the money options to begin to reflect some greater weight of large changes in the tails.
The next question is big.
Uh-oh.
So given the current market condition, how can we hedge our portfolio using options?
I have not a clue. Well, first of all, I'd have to know your portfolio, so that's another story. I will fall back on the classic economist answer, and that is diversification is the only free lunch. Basically, the biggest thing you can do is, for example, one of the big questions today, it's a big question I have. We've had a long period of stagnant inflation, low interest rates. A lot of people are beginning to worry about, with all of the spending, with everything that's going on, that we may be moving back into an inflationary period. I cut my teeth in economics starting in 1973 in the first Arab oil embargo, and I lived through double-digit prime interest rates. So the real question is, how can we hedge against the uncertainty about that at the moment? Well, you need to have some assets that are fixed return, so that if rates remain low and if other things, inflation is under control, you have some assurance of continued income. But you also want some real fixed assets, real estate, maybe precious metals, things that will appreciate in the context of an inflationary situation. It's a bit of a cop-out, but it's basically the only honest answer.
Well, I think that, everybody knows that knowledge is power, right? So it's really about, you don't do things that you are not knowledgeable about and learn. And we're so fortunate to have this opportunity to learn from Dave directly, thanks to CASPA. So next question is there
But
any?
let me make one comment on that too, by the way. That's part of the reason why I developed this presentation, because as you say, if you don't understand something, you instinctively shy away from it. I mean, it's a perfectly rational thing to say you should be overcautious if you don't understand. If you have credit officers in a bank that are just uncomfortable because they don't understand all this trading stuff, they tend to be too tight with limits, for this activity. And if you can help them understand so they get comfortable with what's going on here, they can make more reasoned judgments about what the risk is and make more sensible decisions in the end.
Yeah, absolutely, absolutely. When you don't know something, then your immediate reaction is fear, and then you just a fight or flight. You basically flight, and then you go away. The
Right,
next
right.
question is there any computational tool recommended to make some simulations?
Well, for the purpose of option pricing, is that what you're? I'm not sure of the question.
Uh, I would assume so, because we're talking about option pricing. I think that
Yeah.
if it's different, then the one who asked this question can
Okay.
can, add something.
Let me answer what might be a related question. What do you do for an Asian option where the payoff is the average price over the entire life of the option? Well, from wherever you are in the life of the option, you have to look at what's all the remaining prices, not what's the path every single day, right, to come up with a possible value for the average price. So in that case, it becomes horrendously computationally intensive if you can just do any kind of potential, path. So a lot of times what people will do will be binomial or trinomial trees. They will try to create a kind of sparse distribution over the life of the option that is representative of the density of the possible outcomes, and come to a less burdensome way of looking at a limited number of representative paths that will get you to an appropriate estimate of the price, which is really just trying to cut down the amount of computation that's required. Though, of course, compared to when we were working together, you learned almost 30 years ago, computation has come down in price amazingly, right? So this whole business of trying to economize on computer cycles is much less of an urgent financial requirement than it was in terms of supporting option trading 30 years ago.
Yeah, yeah. The next question is easy. How is the volatility defined?
Well, it's the percentage change in the price over a given period. What's usually assumed is it's quoted as a daily volatility, which rises by the square root of time over multiple days. That's usually how that volatility is defined. Now, how is it derived? That's kind of like saying, how is the price of IBM derived? Right? There's no magic price of IBM or Microsoft. It's a price at which the market is kind of balanced. Some people think it should be higher, some people think it should be lower, but the difference of opinion is spread out to the point that anybody that holds Microsoft shares, let's say, doesn't feel urgently a desire to sell them, and people who don't have them don't feel they're compelled to buy them because they think they're so cheap. So it's the sort of market consensus that gets you to a price of Microsoft. It's very much the same for option trading. It's a market consensus as to what representation of volatility seems to make sense. Some people will say, no, that's too narrow. There's a lot more volatility out there, which is why I say option traders are trading volatility. They will basically want to be long options, because long volatility, because they think volatility is going up, and it's going to, if they own it, it's going to become more valuable. So it really is a question of consensus market view that balances off the people that are on one side and people on the other side of whatever is the the consensus distribution?
Well, I learned a great deal, and I'm sure the audiences learn a great deal as well. Look at the time that we have. It's time for our scheduled fireside chat. And we still have many questions as well. So what we will do is that we will have those questions answered after the chat. And then, of course, feel free to continue to ask a question if you have questions related to the chat. So we all know that Dave have his book published, An Insider's Guide to Risk Management. It's really, as I said, I have translated his book from English to Chinese. I learned a great deal. The language, even just the English language, is amazing, amazing. And there are many stories in the book as well. So feel free to buy either the English version directly from Amazon or pre-purchase the Chinese translation if you prefer Chinese. And I just think that it's going to benefit anyone, everyone. Doesn't matter whether you are a risk management expert or not. The learning, the thought patterns, it will help you change your horizon so that open your mind to think differently. And that I think is invaluable. You may, for those mathematically a little bit of challenge, you may have some mathematics, but that's in overall, I think that should not be a problem at all because they've explained complex theory in very simple terms. So I would strongly encourage you buy the book, study, because you know, those kind of theory may sound simple, but on the other hand, knowledge is it's nothing if it's not understood, and also most importantly applied in your day-to-day work to help you whether do trading or to help you design a road to success strategically, so that you can apply the knowledge to calculate, take risks, but take calculated risks. And then especially learning from a economist, that's something opportunity very rare. So Dave, I know that, you know, we used to chat a lot, but today's chat is like a public chat. I always benefit from you a great deal, always chatting with you. So regarding the book, as we know that, you know, there are so many books on the quantitative mathematical techniques used in risk management already. Why would you write yet another book? And how does your book differ from those that's already out there?
Well, I would say a lot of what's in the book is based on the column that I wrote for Risk Magazine for 16 years. And when I was asked to write that column, my instructions from the editor of Risk Magazine was, look, we get more highly complicated technical mathematical material coming in that we can possibly publish. We have, you know, more of that than we can deal with. We don't want another column like that. What we want is a column that's more, what is life like down in the trenches? You know, what actually is important in actually making decisions. And if anything, I would say one of the key things that I say in the book is, I assume that people have mastered pretty much the sort of techniques of creating very evaluate risk models and this kind of thing. But under what circumstances do you take the precise answer that mathematical model gives you and take it really seriously? Or when do you step back and ask things like, well, do we have all of the data we need to feed the model? How reliable are the data that we're using to feed the model? Are the assumptions of the model, you know, like I at the beginning said, you know, stable random distribution, that is an assumption of the Black-Scholes pricing law. To what extent are those not really consistent with the current short-term environment, let's say, or long-term environment? So it's more a matter of, it also deals with some of the questions of difficult organizational problems. It's very difficult in my experience to get a big organization to deal effectively with large risk issues. I think we've seen this in the whole COVID thing, for example, that dealing with risk on an organizational and even more on a societal level is an extremely difficult process. And I talk a little bit in the book about how to deal with stress tests, which are highly unlikely but very damaging events. And how do you get people in an organization to sit down and play the game, think seriously about this, and at least make it part of their ongoing process of decision making, even though they know it's rare, but ultimately you need to incorporate it into your thinking. So it's much more a kind of street smart, down at the coal face. What are some of the problems you face as a risk manager once you have the models all in hand?
Yeah, I haven't read the book myself, and I haven't translated the book myself. I absolutely agree with you. This is just the 40 years of real working experiences in the field, which is so different from the theoretical books that's out there. So if you would like to benefit learning from 40 years of working in the field, this is absolutely the book to buy and learn. And then this is one of those books where you will read the first time and you benefit from this level, and if you read it again, you will, wow, this is something I never thought about.
Well, one of the things I realize is there's a lot of stuff I know today that I wish I'd known 15 or 20 years ago, right? And one of my favorite sayings is it's a lot better to learn from the mistakes of others than to have to make them all yourself. So I'm trying to share some of the ones I made so that other people younger than I will not have to make the same mistakes to learn the same things.
Oh, by the way, CASPA is supported by many sponsors. CASPA is very fortunate. So if organizations would like to buy group purchase, feel free to contact Dave or me directly, and we can give group discounts. This applies for both the English version and the Chinese version. And then LinkedIn and the CASPA is the best way to contact us. Now, regarding the book, you write in the book about what you call the two phases of risk. What do you mean by that?
Well, I think the risk profession, of which I was a part, for a long time after we began to develop value at risk models in the early 1990s, felt that analyzing short-term market volatility, measuring short-term market volatility, using that as a proxy for risk was the complete job. And I think one of the really important lessons we learned from the subprime mortgage crisis is that systems can be seemingly stable in the sense that short-term volatility is low, but also brittle, that there are certain structural things which, subjected to enough stress, can result in major problems. And in 2006, 2007, volatility was low, interest rates were low. There might be some little event somewhere that would cause some volatility, and then pretty quickly it came back down. And partly it was because the markets were so dominated by a handful of large major players with very deep capital. The problem is, if you get a market like that, that's concentrated that way, if you get an event big enough to threaten one of those big players, and in this case it was Lehman Brothers, and when Lehman Brothers failed, that was a big deal. And it had repercussions all back through the market. And so basically stress testing and potential systemic risk is the other face of risk that I think, yes, people talked about stress tests and this kind of thing, but really most of the resources were devoted to short-term volatility. And we really need to balance our view of that much more effectively. It's hard because the systemic risk side is low probability, hard to get management to focus on it, but it really is important to give serious thought to that side of risk as well, not just the short-term volatility, building VAR models, and if the number looks okay, we say, okay, we're safe. That's not enough.
You argue that over a sufficiently long time horizon, stability is actually destabilizing. What do you mean by that?
Well, we have been through a very tranquil period in a lot of ways. And what happens in periods of comparative stability is people start to reach for yield. Interest rates come down, nominal yields are lower, nominal returns, and a lot of people begin to think, oh, well, this lower level of market volatility is permanent, and they try to get back to the old level of returns by leveraging up, borrowing and investing in more volatile assets. And that can work for a while as long as the stability is lower, but what happens is it can leave you very vulnerable across a large number of sectors if people have let themselves become overextended. And to some extent, that is what happened in the aftermath or in the subprime mortgage crisis. Too many people got overextended, and Bear Stearns, for one, basically ultimately failed because they got overextended, thinking that this is going to go on forever. Citibank, basically, as long as the music is playing, we got to go out and dance. Well, no, the point is we got a major shift and a kind of feedback loop that fed on itself over time. There is a whole section in the book on systemic risk and how to think about systemic risk and how systemic crises unfold and how should we go about trying to analyze this. It's much messier than building value at risk models because it's just not as easily captured in any simple way. You have to just wrestle with all of the various complex dimensions of it.
CASPA is made of professional semiconductor professionals, and in any business, it's very important to have a healthy operation culture. In your book, one topic you highlighted is the problem of two cultures. What does it refer to, and why is that a problem?
Well, the term two cultures goes back to it's the title of a book by C.P. Snow, who was both a trained scientist and competent in scientific methods and mathematics, but he was also a writer of creative fiction. And these were the two worlds, the two cultures he was talking about: the artistic world, writers of fiction, drama, that sort of thing, versus scientists that are using mathematics in very specific, well-defined terms, and that there was hardly any discussion, any talk across the divide of those two cultures. And in business, particularly in trading, there's a very obvious example of that, which is the quants who know all of the mathematics inside out and upside down, and the traders who really don't know all the math, but they have a kind of a gut feel for the markets. They have a sense of history. They have a sense of how do I interpret what I hear in the street, right? And somehow we need to get those two cultures to talk to each other. And part of my thought was my role in my career, and this presentation was an example of it, was trying to get more understanding from, let's say, credit people that really weren't mathematical, of enough of understanding on their part of what was going on so that they could be comfortable and make sensible decisions by somewhat bridging the insights and the skills across these two different segments of the company.
You also argue in the book that risk managers should avoid being viewed as the risk police. How should they go about doing that?
Well, risk management typically is involved in setting limits, and traders don't like to be constrained, and so there's always a conflict here. But I think the answer is that the risk management's goal is not to eliminate all risk. A company will die if they don't take risk. You have to be prepared to do balancing off risk versus appropriate return. And so the other side of it is, if there's a good relationship and professional respect between the risk management people and the business people, the risk people can be very helpful to the business people because they're usually coming out trying to look at a new product or a new undertaking. And of course, their advocacy for this is somewhat tainted by the fact that they have a vested interest in the answer. They want to do this project, right? So risk people who are more neutral but presumably informed observers, if they can look at it, analyze it, explain it to senior management effectively, they carry more weight in getting a favorable decision than the same argument made by the business people who have obviously a vested interest. It's also the case that I think risk people, in building their systems, their analytical tools, their oversight, they need to realize that you're not trying to eliminate risk, you are trying to manage risk. So you need to measure it, inform not only yourself, but the business people at the operational level, as well as their management going up to more senior management. What are the risks that you're doing here? What are the risks you're taking? And so that those risks can in fact be weighed off. At some level, risk people have to be the risk police. They are the ones who ultimately have to say no. And yet they really should be trying to find a way to make sure that you are arguing that issue on a sensible playing field, that you don't have measures, for example, which are not properly capturing the full dimensions of the risk or distorting the risk in some way. That's going to reduce into a sort of a war of one group against another that's never going to end. There's always going to be disagreement, but at least you want to try to be disagreeing on the basis of analysis that you commonly understand and respect.
Yeah, CASPA is a global organization that connect innovators together, and many of the CASPA members actually work in startups, so they are not afraid of taking risk.
Right.
So you are talking
Understood.
to a group of brave individuals here. You also made the point that risk is everywhere and always a portfolio problem. What are some situations where organizations fail to recognize this key point?
I think the most glaring example of that is when you come to the annual conversation about an allocation of some investment resources to different projects. And everybody's got their project they want to undertake, and they're doing the cost, and they're doing the benefits, and they're estimating the market, and they're coming up with some kind of rate of return. And too often the approach, which on the surface may seem to make sense, is, well, we'll just, as long as we've talked them down and we think they're not really padding their numbers anybody more than others, we will take the highest return one first, and then we'll take the next highest return until we run out of money. Well, that's not really a very effective way to approach it, because you're totally ignoring the risk. And in some cases, you may be doing 3 projects where the risk is all the same way. And so you're piling one risk on top of another, whereas maybe a second or third project, which has a slightly lower return, has a risk profile that is different from, maybe independent or even counter to, the risk profile of your first one. And that's the dimension when you come to these large strategic investment decisions that often gets lost in the process totally. So again, I think that we always need to remember that risk is ultimately a portfolio problem. We need to look across the whole dimension, not one area at a time.
Yeah, we all know that Darwin said that the one who survives is not the one who runs the fastest, but the one that who adapt to whatever.
Well, there is that. Yes, exactly.
So regarding adaptation, you said that adaptation is actually a key process that risk managers need to keep clearly in focus. What is an example in the past where risk managers failed to do so?
I think when we started developing value at risk models in the early 90s, and I'll admit to some culpability in this, like we finally, before that, we had all kinds of little micro limits, aggregate long and short positions, aggregate sort of spread positions, nobody really knew how much risk was implicit in all of these little micro limits. We developed value at risk models where we tried to simulate what's the volatility of the P&L based on market conditions if we take all these positions together and we look at the way they are not perfectly correlated, or maybe some of them are offsetting and so on. And we thought, oh, well, we finally got it knocked. We're done. This is, we can just turn the crank now. Well, one of the things you discovered is that one of the tricks that option traders would play would be they sell out of the money options that are far enough out of the money that they can collect premium on them. But if they build up enough of a book, they still don't show up that much in your day-to-day value at risk numbers, unless the market moves far enough, and then all of a sudden it jumps up in your face. But now it's too late. So that was one of the ways in which I think people tended to be fooled into thinking we'd solved the problem forever. One of the ways I put it is risk managers always have to remember we are part of the system whose risk we're trying to control. And people are reacting to the way we try to impose certain limits and certain constraints to keep risk under control. And you always need to be asking how are traders trying to work around the systems that you put in place, essentially it's a never-ending battle. Larry O'Brien, who was a Democratic Party operative, but also at one time, I think, chairman of the National Basketball Association, wrote a book called No Final Victories. And I think risk managers need to keep that in mind. There are no final victories. You never have the perfect system in mind that's just going to do the job in perpetuity, because people are always finding ways to work around it. You've got to be conscious of that as you move forward.
Yeah, CASPA stands for Chinese American Semiconductor Professional Association, and many of the CASPA members, they are originally from China, and as Chinese, there are two famous books. One is I Ching, the Book of Change. Another one is The Art of War. I'm sure that many of the people in the audiences would naturally think about those two books, and especially for me, I definitely would read your book and translate your book. I definitely connect your book directly with those two famous classic books, because in my mind, I have the knowledge of those two books, and I have knowledge in your book. To me, they are all great books. But on the other hand, many of the Westerners, they may not have the advantages that many of the CASPA members have in terms of, have a good understanding of the Eastern philosophy, Eastern books. And especially, there are strategy books, and then they really can leverage the books in strategy to manage risk better. Now, the question is, how would you see Western business decision makers can leverage your book, as well as the books, strategy books from China, from Eastern culture, so that they can have a different mindset, increase the probability of success?
Well, again, it's been a long time since I read The Art of War, but my basic recollection is that the best strategy is to win without having to fight in the first place. And that's perhaps one of the important lessons. In general, I said at a conference, I think it was December of 2009. So it was 14 months after the subprime mortgage crisis was well underway, but we were still struggling to find our way out of the morass. And there was a guy from Capital Economics that was asked after he did a rather critical keynote address and quite critical of risk managers. And someone raised their hand and said, well, what do you think risk managers should do differently? And without more than a couple of seconds thought, he said, well, frankly, I think they should read less mathematics and more history and literature. And I think that's part of the point you're making, that books of broad philosophy, broad historical behavior are really important. And if we get too wrapped up in technical details, we discover that we've just ignored some really big issues that weren't quite amenable to the same level of technical analysis that some other things were. An example, I think, is the work that we did at Bank of America. The way they were measuring counterparty credit risk was so ham-fisted and so in some cases almost directionally incorrect, that you had this constant war going on between the traders and the credit people, and and a lot of heat and anger, partly because you were arguing over numbers that weren't nuanced and proper ways of looking at the underlying risk. By building a system that came much closer to estimating that risk in its full nuance, we still had disagreements, but at least we were arguing on a playing field where we kind of all accepted the basic numbers that were there. We understood where they came from. How big is big? Is this company worth more risk than that? You're still going to have those arguments. At least we weren't arguing over these numbers are stupid and they don't tell us anything and just to give us the right. So it was a way that our goal was to manage the risk more, to reduce the risk effectively. But we did it not by just winning this war of words, but by introducing a new and different way of looking at the problem that was more effective and more accurate, more defensible. And it actually gave us better management of the risk and actually less heated back and forth between the two sides. So that's...
Absolutely, I can't agree with you more on the benefits of history, philosophy, economy, and many other fields that is not STEM.
Sure.
and as we know that risk management is really essential part of PMP, project management professional, and also strategy management. This topic is typically reserved for high-level business executives and less discussed among early-stage young professionals. And we all know that risk management is important. So CASPA offers this platform that gives our audiences opportunity to broaden the scope of understanding and see risk management so important part. So question to you is that, what advice would you give to young professionals and those who would like to move up the corporate ladder and would like to understand the business side better and learn to become more intelligent to strike, for example, intelligent conversation with companies' business leaders and become much more savvy in business?
Well, again, I go back to the comment from the guy at Capital Economics, don't just read technical mathematics or software development. Take yourself out of an area where you undoubtedly tend to be comfortable and you have background and tools and you're successful for a reason. But at some point in your career, if you want to rise above a certain level, you really have to have a broader insight and understanding. So spending some more time in your free time, reading literature, reading some of history, trying to find circumstances. One of the great quotes, it's not anything you wrote, but it's attributed to Mark Twain, which was, history doesn't repeat itself, but it does rhyme. And one of the things, the older I get, the more wisdom I find in that remark, because once you've studied some history and then you've lived some history, something new emerges and it will begin to remind you of a past circumstance. There's a certain rhyme to what's going on there, and you think, no, wait a minute, let's think about what happened when something similar happened the last time. Why did this happen, and how should we be moving forward? So essentially broadening the scope of your interest in reading, I think, is important. And it's not always easy, right? Because we all tend to focus on things we know well and do well and perform well. So it's kind of a discipline to kind of force yourself into some areas that maybe you wouldn't have pursued otherwise, but you'll discover that breadth will pay off in the long run.
Yeah, the ones that who participate in today's talk, we feel really fortunate that we learn a great deal. And I know from the book that there are so many history stories and there are many literature references. It's not just a book written by economists, by a risk manager expert. It's a historian perspective. It's a literature perspective, and that is the book itself is amazing. Now, I also want to point out that in the business world, as we see that, you can see, in addition to the CEO roles, you'll see that CRO and CSO, specifically Chief Risk Officer and the Chief Strategy Officer, they are becoming a trend, because you can see on LinkedIn, you can see, they are popping up everywhere. Now, how would you advise people engage with you, especially those CXOs, in addition to just buy the book?
Right. Well, I still do some consulting, and in that sense, part of the trick here is to take the general principles, the general sort of mindset and point of view, and interpret it in the context of an existing current situation. In some sense, it's looking for those parts of history that might seem to rhyme with the current circumstance, and that's always a very kind of messy issue that's specific to a given current situation. And in that sense, I think it really is relevant that you have all of the different perspectives. And I guess one of the things that I maybe in my career have been able to do is to bring people with these different perspectives from around the table together and talk, in a group that maybe they wouldn't have been so readily able to do, one-on-one. They wouldn't have maybe opened up the channels of communication as well. Not that I have all the answers, but I'm sort of open to ideas and able to ask suggestive questions in some sense, which is often the most important thing.
Yeah, we know that you worked with Alan Greenspan. Everybody knows Alan Greenspan. And what's amazing is that he actually wrote a recommendation for your book, which is part of the book. For those of you who are interested in learning more about Alan Greenspan, you have one connection.
That's right.
So we have many questions, and we, in the interest of time, let's jump to some of the questions that are related to the feel free to ask more questions, and let's try to see if we can finish them. So how far do we usually go back calculating the realized volatility? The past 3 months or the past 1 year?
That is a question where there's no definite answer. The usual, I think the evidence is mounting that you're better off typically to take a comparatively short recent history so that your volatility estimates will be, adjusting. Now, this is actually the volatility estimates you use in, let's say, your risk assessment, right? This is the key. The volatility that was implicit in the pricing analysis that I displayed is what's called implied volatility. That basically, the option price, you need to back out what is the volatility that is consistent with that option price, because if you know one, you know the other. And so, in effect, that volatility is really a forward-looking market consensus of where you think volatility is, and that may change overnight if you get something like the news conference I described where you got blowout numbers for Tesla and Elon Musk in a hospital and we're not sure how sick he is, right? But I think in terms of volatility for let's say value at risk models, the general consensus is that you probably need to look at probably not much more than a 3-month history, because you want the volatility numbers that you're feeding into your risk models to be pretty quickly responsive to changes in market conditions. And so that I think is typically the answer.
How would I know the market direction? So this question, how would I know the market direction? When Mr. Trump became a president, then I did sell out all my stocks.
I see.
That's a question from the audience.
Well, the answer is you don't. And if you did, you would be so rich you wouldn't be sitting here listening to me. And if I did, I wouldn't be sitting here talking to you. It's basically, I think it's all too easy to jump to a certain conclusion, right? You may think, oh, this is going to be a disaster. I have to sell everything or I have to buy everything. Again, diversification is the only free lunch. So yes, you might want to say, I'm worried that the market's going to go down. At least I'm going to sell part of my portfolio and go to fixed income, but at least I can, begin to watch what happens and see if it, see how it plays out. I mean, we are in a very, very difficult situation on that today, right? Because a lot of the fiscal stimulus potentially is going to push markets higher, but the question is, in the long run, are we getting into an inflationary wage price spiral that could be a problem, which is going to be a disaster for markets eventually? There is no way to know.
Yeah, many of the members work in startups. So one question here is about startup options. So what might be the difference in valuation of stock options for a startup?
Unfortunately, in the case of those kinds of options, you really don't have a market, right? I mean, this is more a structural question, and it really comes down to how individually confident are you that the product in question is in fact everything it needs to be, that it is going to take off, it is going to get a hold, it really is going to perform. You don't have typically a price, right? You occasionally raise new capital, and so you get a new price after 9 months or something that said, oh, well, implicitly that implies that the value is thus and so. You can't really use the kind of analysis I've described on something which isn't actively traded, because you simply don't have the information to do that kind of analysis. So you really have to fall back on the judgmental question of how confident are you in the nature of the product, the quality of the product, and where it sits in the market that it will in fact take off.
Yeah. Next question is, how would you predict the market direction? Is it the corruptions?
The answer is it's going to go up if it doesn't go down, right? I must say, I do think I'm a bit nervous at the level of the market, but then with the amount of stimulus that's been fed into the market for the next 6 to 9 months, I can certainly see the market continuing up. The real question becomes, what happens, by the end of the year. Some of that stimulus will have faded. Where are we going to be? Will the concern about rising prices create a problem? I mean, if you're going to look at one big systemic risk today, it's that a lot of companies have taken on a lot of debt, as has the U.S. government, at what have historically very low interest rates. I had a job in 1968, a summer job at Morgan Guaranty Trust Company, and was looking through loan folders back in the 1920s and early 1930s and looking at prime interest rates of 1.25%. And I looked at you and I was shaking my head, oh God, that's just I'll never see anything like that again, right? Well, here we are, right? So it's very hard to know, actually, these big swings, but we've been in quite a cycle since we killed off inflation in basically the early 1980s. And there's a real question of to keep your eyes open as to whether we are eventually going to reach a turning point where wages and prices take off. And if it does, that's a problem, because it's pretty hard to get them back under control once you let the genie out of the bottle.
Yeah, a related question here is that we all know that our government is, keep dumping money in the market. Why would they do that?
I'm sorry, the federal government?
Yeah, the government currently is dumping money in the market. Why did they do that?
Not really in the stock market, but I mean, they're basically in the bond market. They are keeping interest rates low. No question about that. And partly it's a concern about, particularly after the whole COVID experience, are we going to get a natural recovery, or might we get a significant downturn if people start to pull back? I think the evidence is pretty clear that that's not the case, that with all of the public spending that's gone on and the payments that have been made, general payments to the public, a lot of people have saved a lot of money. And it may be more like the end of World War II, when there was a lot of saving and people had been deprived of opportunities to buy things and to enjoy, the fruits of life during the war. And we had a big boom, right? So it's very possible, but then that gets the question, if that happens on top of all the continued spending, are we going to get into something which is a wage price pressure that ultimately is not sustainable?
Yeah,
I know that's that's a two-handed economist, but those are the issues, and we just need to keep our eyes open as to which direction we seem to be going, and if and when the worm is going to turn.
Yeah, it's 6 o'clock, and it's time to end. On the other hand, we have 3 more questions. So I wonder, Dave, would you be okay if we finish those 3 questions?
I'm game for 3 questions. I'm game for 3 questions if you are.
Okay.
We'll say people can leave, and we won't hold it against them if they need to be somewhere else.
Yeah. So please feel free to leave if you need time constraint. If you have time constraint, and then otherwise we'll just finish those 3 questions because they are really good questions. In fact, I see that one of the questions from my longtime friend, he is an expert. I would highly recommend, if you want to learn about trading stock, then learn from him. Here is his question. Volatility used in Black-Scholes is based on past data. The payout is based on the future volatility. How can they match? Is that a flaw in Black-Scholes theory?
I think it is incorrect to say that the volatility used in Black-Scholes is historical volatility. It typically is the implied volatility in the recent past. That's one way to look at it. It is essentially you observe option prices, that's clear. And the idea is that you back out the underlying volatility. Now, the distortion to some extent is the earlier question that you're building it around a normal distribution, which may not be the correct distribution. In particular, it is too thin in the tails. Actual market changes are clearly fat-tailed distributions. So you might say, well, yes, to some extent it is a weakness, but ultimately, the volatilities that you're using that are underlie the prices are essentially market implied volatilities that essentially justify what this price is at a given time. It's not just looking at historical volatilities and then applying them to the market and saying that has to be the price, because the implied volatilities are always going to be at variance to some degree with essentially historical volatilities.
We know that artificial intelligence, quantum computing, and advanced wireless communication technologies such as 5G, 6G, they are really those important topics for semiconductor industry. So the next question is quantum computing. The context is that a quantum computer can be a hype or a fashion right now. Many people are not expert in this. So the question is, do you know any research in this area?
In quantum computing?
Correct.
I can't say, I'm one of the many who's not terribly informed about quantum computing. I understand in principle the concept. I must say there's a certain puzzlement still in my mind about exactly how that would work and how it would be implemented. But in terms of consequences, one of the things that we really need to think about in terms of consequences is there's a whole a whole area of quantum safe encryption, because the typical encryption algorithms are such that they, you have to solve a hard problem. But with quantum computing, some of these really hard problems become not so hard anymore, or become quite tractable. So in terms of how realistic it is, how quickly it's likely to take off and to be practical and reliable, I really don't. I follow the literature casually from time to time, but I can't really give any insight that would be worth betting any of your retirement funds on. Let's put it that way.
Yeah, well, Intel and IBM, they both made a lot of good progress in this area, and applied to this talk. Okay, so there's an amendment from the one who asked this question. So would quantum computing related to this talk applied to this talk?
I guess the one thing I would say, the whole point of the Black-Scholes formula is it was there's a wonderful story. It's one of these stories that's, it may not be true, but it's too good to check. Okay. Supposedly Black and Shoals had worked out this problem, and they'd set up this equation that they needed to try to solve. And somebody that was one of their graduate students that was a undergraduate electrical engineering major said, "Oh, that's the heat diffusion equation. Here's how you solve that." and that's basically what it is. If you think about it, price diffusion through time is modeled with Black-Scholes in much the same way that heat diffusion across a surface is modeled, right? It spreads out, forward and in two directions. And so there are electrical engineering equations to model how that works. And that really is what the Black-Scholes formula is the heat diffusion equation. It was a clever closed form mathematical way to arrive at the answer, i.e. the expected value of all the future outcomes discounted back to present. So essentially it was a way of economizing on computing. And obviously it's less important today than it was when it was created, because computing has come down a lot in terms of cost. And with quantum computing, it might become almost meaningless, to be honest with you. The cost might be so low in terms of that you wouldn't even necessarily want to use Black-Scholes. You just use brute force all the time.
CASPA community is full of people with practical hands-on experiences, wants to put your theory into practice right away.
I see.
So the last question is exactly asked. It's a very good question in this area, because people want to learn, okay, now I know this theory. How would this theory help me to evaluate a particular option? Is it overvalued or is it undervalued? Can we give an example? So for example, specifically, one of the question here is, let's say Tesla's option with expiration date on April 30th, which is a week later. Currently, the put option price is 657. The put option at 657.5, which is 10% below the current price. It's $7.15, 7.15. So the Tesla 430, like a week from today, with at the money 657.5, which is 10% below the current one. Okay. Now the price for the put option at 7.15. The question is, get the parameters right. Okay. So the question is how to judge. How would one tell this option is overvalued or undervalued? If it's undervalued, it sounds like it's good to buy. If
right. Well, and the fact is, certainly as an external observer, there's really probably no good way to do that. If you're an option trader, this is what you do for a living, right? And the way you do that is you try to look at what's happening in the market, what's happening in attitudes towards electric cars, what's happening in terms of perhaps maybe there's a forthcoming announcement of someone else that's going in to compete in this field. Maybe there's some legislation that will have an impact on, favorable or unfavorable towards electric cars. All of these things, you just have to weigh all of them and decide, do you think this market for Tesla is not just directionally, that's part of it, but do you think it's going to become more uncertain? Is it less stable in terms of the way the price will shift around over time than it has been in the past, or than it seems to be today? Unfortunately, answering that question has got to be weighing a lot of different circumstances that really just basically have to be pulled together in a way that's not real clean and easy.
With that, that's all the questions, and we are actually on time.
Pretty much. Okay.
Well, thank you so much, Dave, for kind of sharing with CASPA community. Really open eyes for many of us, especially the STEM majors. Thank all the audiences who join us, enjoy this talk. Would you like to, so here is, by the way, here is the join CASPA so that you can scan and connect with us on many places, WeChat, LinkedIn, Facebook, or email us at join@caspa.com. Dave, would you like to give us a summary?
Well, again, I think just very quickly, we are a little late, but again, I think the key is if you can find ways to exhibit fundamental ideas without overcomplicating them, I think this is really quite an important skill. And it's many ways to develop getting done what you would like to get done in an organization without just going head to head and trying to sort of have a battle. I just get back to the art of war. If you can find a way to come to the conclusion without having to get what you need, without having to fight the battle, you're probably better off in the end. It's not always possible, but I think in many cases it is possible to make that strange combination.
Well, thank you so much. CASPA is, as Young pointed out, that CASPA are made of volunteers, and they're all leaders in the industry. I'm sure that today's talk will benefit many young leaders. They are rising, and CASPA has a bright future, and the young leaders who are with us today will have definitely a bright future as well. With that, thanks to all who join us, and enjoy a very beautiful evening, and good night.
Or a morning if you're in China.
Yes. Actually, we have people join from China.
I see. I know.
That is amazing. So wherever you are, good morning. All right, join CASPA.
Thanks, everybody. Bye-bye.